Welcome to The Explainer. Today, we're cracking open the financial analyst's toolbox to answer one of the biggest questions in business. What is a company really worth? Every single day we see stock prices flashing across our screens. They're up, they're down. But that price, that's just what someone was willing to pay for one share at one specific moment in time. The much deeper question, the one that analysts wrestle with, is what is the intrinsic value of the whole company? Are you actually getting a fair deal, a bargain, or are you maybe overpaying?
So here's our game plan. First, we'll dig into that price versus value puzzle. Then, we're going to explore three key tools from the Analyst Toolbox: valuing the payouts, looking at the cash engine, and using comparison ratios. And finally, we'll see how an analyst puts it all together to make their final call.
All right, our first tool is the most direct one. It focuses on the actual cash a company sends back to its owners, the shareholders. Yep, we're talking about dividends.
The idea behind the dividend discount model, or DDM, is actually pretty simple when you think about it. If you own a stock, what you really own is a claim on its future profits, and the most tangible piece of that profit is the dividend. So this model says a stock's true value is just the sum of all the dividends it will ever pay you, all added up and adjusted for the simple fact that a dollar you get tomorrow is worth less than a dollar in your hand today.
Now, the most popular version of this is called the Gordon growth model. It makes things way simpler by using one huge assumption, that the company's dividends will grow at a steady, constant rate forever. Now, I know that's a big if, but it lets us get a quick estimate of a company's value with just three little inputs: next year's dividend, the return you demand as an investor, and that forever growth rate.
And this right here shows where the real work of an analyst comes in. You see, the formula itself, that's the easy part. The hard part is figuring out the right inputs. What's a reasonable return to expect from this investment? What's a believable long-term growth rate for dividends? Because the final number that pops out of the model is only as good as the assumptions you feed into it.
Of course, this leads to the obvious problem, right? How many companies do you know that actually grow at the exact same rate forever? Not many. Young companies grow like crazy, and then mature companies slow down. So assuming constant growth is a major oversimplification, and that's exactly why analysts need more advanced models.
So to solve that problem, analysts use tools like the H model. Now forget the formula for a second. It's the idea behind it that's so powerful. It actually lets you model a company's real life cycle, a period of super high growth when it's young, which then smoothly slows down to a more stable, mature growth rate over time. It's much more realistic, but it also means the analyst has to make even more predictions about that growth path.
But even the most sophisticated dividend model has a massive blind spot. What about all the companies that don't pay dividends at all, or companies that could pay way more than they currently do? Well, that brings us to our second and, you could argue, more powerful tool. We're going to look past the dividends and value the entire cash-generating engine of the business.
These are the free cash flow models. Instead of asking what does the company pay out, they ask a much bigger question: how much cash does the entire business actually generate? This is the cash that's left over after all the operating expenses and all the big investments in things like new factories are paid for. It's the pure, raw cash that the business just throws off.
And this slide highlights a really key distinction. You can measure this cash flow from two different angles. On the left, free cash flow to the firm is the total cash generated for everyone with a stake in the company. That means shareholders and lenders. On the right, free cash flow to equity is what's left over for just the shareholders after all the debts are handled. Two different perspectives, and they lead to two different valuation methods.
And this is a fundamental rule of valuation. Your cash flow measure absolutely must match your discount rate. It's like pairing the right wine with the right food. If you're looking at the cash flow just for equity owners, you have to discount it by the cost of equity. But if you're using the cash flow for the whole firm, you must use the weighted average cost of capital, or WACC, which is just a blend of the company's cost of debt and equity. If you get that pairing wrong, you throw off the entire result.
Okay, so our first two tools were all about forecasting the future. But what if we just want to know what the company's worth right now compared to its peers? For that, we pull out the third tool from our toolbox: relative valuation.
The logic here is pretty intuitive, right? You just find a group of comparable companies, in the same industry, about the same size, and you see how the market is valuing them. Are they trading at 10 times their earnings, 2 times their sales? Whatever that multiple is, you can apply it to your company to get a quick and dirty estimate of its value. It's basically valuation by analogy.
Now, the undisputed king of these ratios is the price to earnings, or PE ratio. It's simple. You hear about it all the time.
A PE of, say, 15 just means that investors are willing to pay $15 for every single dollar of that company's annual earnings. It seems super straightforward, but like all simple metrics, the devil is totally in the details.
And this is where a good analyst really earns their keep. A ratio is never just a number. You have to understand its weaknesses. PE is super popular, but that earnings number, it can be massaged with accounting choices. Same thing goes for price to book. That's why some analysts prefer the price to sales ratio, because it's a lot harder to fudge your total revenue figures. The key is always picking the right tool for that specific job.
Okay, so we have dividends, we have cash flows, and we have ratios. 3 different tools, all giving us potentially different answers. So how in the world does an analyst combine all this information to make a final call on a stock's value?
So which model is the best one? The answer is, well, none of them. Or maybe it's all of them. As this table shows, each one has a potential fatal flaw. The dividend model is useless for firms that don't pay dividends. The cash flow model is incredibly sensitive to your assumptions about the future. And the ratios model, it just assumes the rest of the market has priced similar companies correctly, which could be a huge mistake. That's why a smart analyst never relies on just one tool. They use all 3 to build a kind of mosaic of evidence, looking for a consistent story.
And the analyst's toolbox is always expanding. Today, valuation isn't just about the financial statements. Analysts are now figuring out how to integrate environmental, social, and governance, or ESG factors. And this isn't just about feeling good. It's about real, tangible risk. They might quantitatively model the cost of a future carbon tax into their cash flows, or they might increase the discount rate on a company with poor governance to account for that added uncertainty. It's a whole new layer of analysis on top of the traditional tools.
Which kind of brings us to our final thought. After all the models, all the spreadsheets, and all the assumptions, maybe the goal of valuation isn't to find one single precise number down to the last penny. Perhaps it's really about the process itself, about building a rigorous, evidence-based story that gives you a reasonable range of what a company might truly be worth. And that allows you to make a much more intelligent investment decision. What do you think?